Let's welcome in Art Hogan. He is the Chief Market Strategist at B. Riley Wealth. Art, it's always good to see you. Let's maybe start a kind of broader question, Art. Julie was pointing out today, you look at the SPX, S&P 500, we're basically flat today, Art, but what a run. It's up about 15% so far this year, Art. I'm just interested, do you think that does that rally continue in the second half, Art, or no, you'd expect us to take kind of a breather here?
Well, I think today is a perfect example, and I think you guys set this up really well. I think it's a perfect example of a lot of folks being concerned that Nvidia and arguably Nvidia, Microsoft, and Apple were such a big part of the 15% that the S&P 500 is higher this year on a year-to-date basis. And what would happen if one of those really fell out of bed? Now, not that 10% down on a stock that's up 140% year-to-date, minus that 10 is a big fall. But you're seeing, basically 3 or 4 days where Nvidia has not been leading the charge, and the market's done very well. I think that continues throughout the second half of this year. I think what we're going to see is if you look at the cadence of earnings growth, the percentage that the other 497 stocks in the S&P 500 are going to be adding becomes much larger. So I think you're going to see the market broaden out and likely see things like energy, which we're seeing today, financials, which we're seeing today, utilities to a certain extent, and likely industrials. To your point, Josh, pick up the baton a bit and start pulling their weight in terms of what happens in the back half of this year. And I think that puts us in a healthier place. I think the concentration at the top obviously has people nervous. And if in fact we work our way through the second quarter earnings reporting season and see other sectors shine, which we did in the first quarter, we saw that sectors other than technology actually do very well. I think this market can really pick itself up in the back half and not necessarily need to be driven by tech and communication services.
Art, does that then imply also that you're pretty optimistic about growth, right? Because obviously the tech increases that we've seen have been boosted by this AI narrative. But for everything else to do well, it just kind of has to be a general growth narrative, no?
Yeah, I would agree with that, Julie. I think when you look at the estimates for the second quarter GDP growth, according to the Atlanta Fed, GDP now, it's north of 3%. We'll get another revision to the first quarter later this week. I suspect that goes higher, not lower. I think we're going to be on pace to not necessarily have that sort of 3.5% GDP growth that we had in the back half of last year, but something like 2.5%, which is certainly above mean and likely enough to be driving profits. So if you look at the earnings estimates for the next 3 quarters, including the second quarter, they gradually work their way higher. And as we all know, that the consensus tends to be a bit low. So I think we continue to see both the economy and earnings grow outside of consensus estimates into the end of the calendar year.
Another catalyst, a potential catalyst, we're watching this week. PCE is on deck, Fed's preferred inflation gauge. What are you expecting to hear there, Art? And what are you expecting from the Fed for the remainder of the year?
Yeah, I'll tell you this. The PCE is a little easier to calculate because by the time we get both the CPI and the PPI, we know what pieces of that goes into that PCE reading. So as opposed to the 2.7 at the core level, we'd like to see that go down to 2.6. And oddly enough, that's where the Fed had actually factored us exiting 24. So we'll be seeing a 2.6 print on the core likely this week. That 2.6 is going to be close enough for government work for the Fed to actually feel comfortable enough in September for their first rate cut. And I think that is likely going to be the start of feeling a bit better about where we are in the monetary rate cycle. We're going to be kind of last to the party as that goes because as we know, the ECB already made that move. The Bank of Canada, the Bank of England leaned into it and likely goes at their next meeting. So by the time September rolls around, we will likely see the Fed cut for the first time, and that probably takes a little pressure off the dollar too. The dollar's been unidirectionally higher since the Fed seems to be dragging their heels to the rate cut party.
I want to just push on one angle there. The Fed, it seemed like there was a moment in time there where it was just Fed all day, every day. Fed. And it feels like maybe it's pulled back a little bit on that. I mean, am I imagining things, Art, or is the market maybe, or investors coming around to the idea that maybe we're not as dependent as the Fed as we thought we were 6 months ago or 12 months ago?
Oh, absolutely. Such a good point. Yeah, so the Fed pivoted. They leaned into being done with rate hikes at the end of last year and gradually, and so we entered this year thinking maybe we get 5 or 6 rate cuts and they'd start as early as March. And that dissipated pretty rapidly through the first quarter, and yet the market continued to rally. So investors have really shown that given the choice between early and often rate cuts and better economic data and earnings, they choose the latter. And I think that's a very intuitive choice to be making. So I think market participants have certainly leaned into the direction of we'd rather the Fed not have to cut, but if they do cut, they can take their time doing it. And if September is the first time they do it, that's going to be great, as opposed to where we were when we started this calendar year, which was assuming that we're going to be cutting a whole lot more. And the good news is they didn't have to, because the economy continues to chug along at above mean pace.
Well, of course, we always have monetary policy on our minds, but lately we also have fiscal policy on our minds, right? As we talked about, we're going to be hearing from Janet Yellen a little bit later in the show. We've got the debate coming up later this week. Do you have clients asking you about the situation in Washington? Are you seeing more of a drumbeat for that? And what are you watching in terms of how it might affect the markets?
Now, I would tell you, when it comes down to fiscal policy, the hardest time to talk about that is an election year, because neither side of the aisle is going to actually ever say anything about cutting spending. And we need to do both. Obviously, we're in a place where our debt is too high, and it's a function of two things. We need to collect more revenues, and we certainly need to spend less. And so fortunately or unfortunately, we're not going to resolve any of that. But after September 30th, we're going to have to start coming to some sort of agreement on what next year's budget looks like for the fiscal year. And clearly, there's going to be no new spending, and there's likely going to be a push to rein in some spending. But there's two sides to this sword, right? And the other side, obviously, is we need to find some revenue generation, whether it's better economic activity or simplifying a tax code, et cetera. So I'd be listening to people that are willing to talk about both sides of that equation. Unfortunately, in a national election, nobody wants to talk about cutting spending.
Well, and we're probably not going to hear it on Thursday night from the two presidential candidates, most likely, because that's not going to get them any votes. But, what would you, in that debate, what would you like to hear come up, or what are you going to be listening for in terms of any kind of direction on economic policy or tariffs, or what do you think could be most important?
Yeah, I would like to have a clear and concise argument made for why tariffs actually work, because I don't believe that they do. I think at the end of the day, it's the end user or the consumer that pays that tariff. So I just think it's bad policy. I certainly understand how that worked 100 years ago, but in the global economy that we live in, those costs are passed along to the end user or the consumer, and that's inflationary. It's higher costs, and there's not a real benefit to it. So I think that's one piece of the puzzle. I think it'd be a great brick in the platform for both of these candidates to remove and say that's probably not the right way to go about this. You could certainly protect American industry without costing consumers more money, and that's one thing I'd like to see get rid of. But I certainly would like to hear a real serious conversation about what is the best way to both find ways to cut spending, right? And what are the best ways to generate more revenue, and what ways would make that sense? And I think that from the Democratic side, they really talked about putting more people to work at the IRS, because there's a lot of people at the upper end of the economic scale that tend to pay less in taxes and perhaps get away with that. But I think simplifying this tax code would go a long way towards saying, okay, we would probably raise more revenues and make things more fair if we simplify the tax code. Again, election year politics, you're likely not going to hear either one of those things come up on Thursday.
You never know, Art. Hope springs eternal here when it comes to the American election system and political system. Thanks a lot. It's great to see you.
Good to see you.